So 4 financial traps that can really stall your growth as a real estate investor. I would say first is having disorganized finances. I see a lot of newbie investors that are kind of in this boat where they're just eager to get that next deal and they're like, oh, I'll worry about the bookkeeping later. That's, a really good way to kind of make bad decisions as you grow your portfolio. It's really important to understand how your properties are performing so that you can use that information to do even better during the next deal and even better and better and better because you're learning as you go. So having disorganized finances can really stall your growth. Next, I would say is not having a real estate specific team. It's so important to have a bookkeeper who understands real estate and a tax CPA who understands real estate. As we know, as a real estate investor, the tax advantages is one of the biggest benefits of investing in real estate. And you want to be working with a tax CPA who is working with real estate investors all the time so that they know all the little tips and tricks and you can be making the most of all of the tax advantages that are available to you. And in order to do that, you're going to also need a real estate specific bookkeeper. Many of my clients come to me with books from a bookkeeper who didn't specialize in real estate and things are just not booked correctly. So especially with things like closing statements, there's so many lines on that closing statement and they all need to be booked properly. So your closing costs, some of them need to be capitalized, some need to be expensed depending on if it's an expense that's a recurring part of the financial performance of the property during the year, or if it's truly just like an expense that relates to the closing of the property, such as title expenses, surveys, things like that. And then also things like refinances or creative loan strategies, you want to make sure you have a bookkeeper who understands those things so that they're booked correctly, so then you can have those productive conversations with your tax CPA. So another financial trap that I see real estate investors falling into is not having a long-term vision. So when you're treating your real estate investment portfolio like a business, that means, putting together a forecast for the year, really so that you can say, okay, you can work backwards from your forecast. You could say, okay, this is where I want to be at the end of the year. How many properties do I need to acquire this month to get there? What do I need to do this week so that I can get there? I hear Brandon Turner talking about this all the time in his podcast is, set your forecast and then work backwards so that you can really monitor your growth as you go, really, and then you can track your budget to actual throughout the year to see how you're performing against those goals so that you actually are meeting your goals at the end of the year. So here are some financial habits that I see my most successful real estate investing clients doing. First, this is one you hear all the time, is making sure you're separating those personal expenses from your business expenses. This is really important from both monitoring your financial performance, but also from a risk perspective. You really want to have a business bank account, credit card, and personal bank account, credit card. Keep them completely separate. Next, I would say is maintaining your performance throughout the year. Don't wait until year end. You want to make sure you're looking at your balance sheet and your P&L monthly, at a minimum, I would say quarterly. That way you can really see how your business is doing and make decisions and act timely in accordance with that. The other habits I see my successful real estate investing clients have are having year-round discussions with their tax CPA rather than just, meeting with them once a year at year end. Also is making sure they're budgeting reserves into their property analysis when they're buying another deal. They understand that these things pop up and that it's important to budget for reserves in advance so that when, the refrigerator breaks or you need new HVAC, it's not going to throw off your profitability. You already budgeted that in and you're prepared when it happens. And last is just reviewing your portfolio performance regularly, understanding which properties are performing, which ones maybe aren't, how can we tweak those properties, do we maybe need to sell that property so that, you're kind of trimming the fat and your portfolio is performing exactly how you expect, and then you can go out and find deals that kind of align with those properties that are successful.